Today's webinar topic is sponsorship compensation explained. And really my goal today is to educate you on how, as a passive investor, how you can spot and determine, is your sponsor structuring the deal where first their interests are aligned with yours, and also whether or not they truly believe in the deal. Besides having skin in the game, besides a sponsor putting in their own capital into the deal and the amount they put in, I would say that the way they structure the deal in terms of fees, front-end compensation, back-end compensation, and just overall waterfall structure is one of the easiest way to tell how much they truly believe in this particular property, in this particular business plan. So today's topics, as I mentioned, seeing how aligned you are with your sponsor. We're going to discuss what each fee is for. We're also going to be talking about the two big forms of compensation that passive investors really need to understand the difference between these. And the first one is kind of the upfront fees. Upfront fees essentially is what the sponsor is making before they actually deliver the result to the investors. Now, the profit sharing, the back-end fees, this is, well, exactly what it sounds like. When they actually performed on the business plan, when they've actually executed it and delivered profits, this is where they get a chance to share into the profits with their passive investors. The biggest thing that I want people to take away today is to know what each fee is for and how to determine this balance. Where you can ask yourself, is the sponsor trying to charge too many fees up front versus how much they're trying to charge on the back end? Whenever you see a sponsor that is very fee-oriented, and I'm going to talk to you today about what the industry standards are, when something is appropriate, when something is not appropriate. If you ever see a very heavy fee load, and for example, a small back-end compensation, that's usually a telltale sign that the sponsor doesn't truly believe in the execution of that business plan, and it's something that you should question. So we're also going to talk about, are the fees in line with the market? I'm going to talk to you guys about various different provisions that sponsors put into their contracts that I would say are bad practices if not disclosed properly. And last but not least, we're going to give you a tool using AI on how you could screen sponsor operating agreements. So in the words of Ronald Reagan, trust but verify. Obviously, ask the questions, get all the information, but then when you take that operating agreement, we're going to give you some prompts that you could put into ChatGPT, where it's going to ask the right questions about that contract and tell you if everything really matches up, and if there's any clauses that you should know about. Quick disclaimer, I'm not an attorney, I'm not a CPA, and I don't want to play one on TV, but I am an investor, first and foremost. I have over 7 figures of my own capital in this asset class. So I deal with lawyers, I deal with CPAs. My goal is really to pass down all the information that we learn in the industry so you could take back to your group of professionals and just make sure that it aligns with your personal situation. A little bit about us and Aligned Ventures. I think what makes us very unique is the way we started out in this business. We never raised capital. We're investors first, and we're syndicators second. As of today's date, we've deployed $10 million of our own capital into our assets. With this next acquisition, we're going to be at $17 million, and that's before ever raising capital. Now, on future deals, we are going to start bringing in investors, but the reason why that's so important is because when you have that much of your own money in the game, when you're looking at deals, you have a completely different lens. You're not looking at it from a perspective of how much money can we make as a syndicator. You're looking at it, how much money can I make as an investor? So we started with that mind frame 5 years ago, and only now that we've built our track record, executed on our business plans, are we now bringing other folks in to invest alongside with us. So I would say that's kind of the big difference between our group and most out there in the industry. Let's talk about the content. So two main categories of sponsorship compensation. So as I mentioned, on one hand, we have these fees up front. And some folks may ask, well, Why are sponsors even charging fees up front? Why am I paying anything before I actually have a result? And that's a fair question. The answer to that is very simple. A sponsor just wouldn't be able to stay in business. And the reason for that is, in order to exit a business plan on a property, it takes anywhere from 3 to 7 years. But in between that time frame, there's salaries that we need to cover, there's marketing expenses. People joining this webinar today, right, this whole setup isn't free, right? We had to market it, we had operations people, we had marketing people, all of that, there's hard costs involved. So just waiting 5 years for when you exit a business plan, you're just not gonna be able to keep the lights on. So fees are definitely, they have their place in the industry. However, there's a difference between trying to keep the lights on and run your operation versus trying to get rich off fees. And this is where today I'm going to be discussing what the industry standards are, and I'm going to give you some examples of various structures that are clearly very, let's say, investor unfriendly. So let's talk about fees. So fees, we have acquisition fees, we have disposition fees, asset management fees, we have loan guarantee fees, and then there are junk fees. And I'm gonna, each one of these fees we're gonna cover in depth. So then on the other hand, we have the promote. Right now, the promote is really the profit sharing. This is where there's going to be a split of the profits that the sponsor has delivered on the deal between the passive investors and the sponsorship group. And we're gonna discuss that. Now, the one thing that I wanna say is the ultimate test to find out whether how much your sponsor believes in the deal is this simple question. How much of your own money are you putting into this deal? And are you putting it under the same terms as our capital? The answer to both of those questions should be yes. The answer to the first one should be a certain percentage. You also want to follow up, and you want to ask when, if somebody says we're investing 5% of our own capital into the deal, I would also follow up and I would ask, that 5%, is that actually physically leaving your bank account, or are you rolling in any of your fees from the deal as part of that 5%? So for example, an acquisition fee is usually about 2%. If somebody tells you, well, we're putting in 5%, but really 2% is coming from the acquisition fee, that's not a lot of money actually coming out of their pocket, right? So these are a couple of questions you want to ask. And the second part to that is it under the same terms as LP capital? So there should be no other answer but yes, it is. Okay, because if people are trying to structure where, for example, they're in first priority to recover money before you, that's not investing alongside your investors. That's a completely different share class. So I would say that would be probably the biggest thing that I would be looking at when investing with a sponsor. And the second would be what we're going to be talking about today, is how to spot these various imbalances. Before we go into each fee, let's discuss how do sponsors determine how much to charge based on different deals. And really, there's kind of three things to that. Number one is how attractive is the deal itself? Two, what type of connections does the sponsor have? So sponsors that have been in the industry for a long time, made a lot of investors, a lot of money, right? It's very easy for them to raise capital. Today, a lot of people also know about real estate syndications, and raises could fill up in a matter of weeks. 2-3 weeks after an offering is published, it's kind of filled up, right? So if there's a lot of demand, sponsors know that, right? We keep abreast to what's going on in the market, and we kind of determine what the compensation should be. And then also it's personal liquidity. How much of your own personal capital do you have? So it's really just comes down to your ability to be able to raise funds and how attractive the deal is. The more attractive the deal is, you did a lot of work to go find that deal, so it only makes sense where you could potentially charge a little bit more on an acquisition fee or on a profit sharing. But nevertheless, it should always be a split of the sponsor wins when the passive investors win. And the upfront fees should only be covering the cost of operations, but again, not for some huge profit potential. So let's talk about risk profiles quickly. I got this chart up here. Risk profiles is, we need to understand different deals are going to deliver different type of returns. There's 4 types of kind of buckets. There's core plus, value add, and opportunistic. And core deals are kind of your brand new product, just built, fully occupied. It's cash flowing right now. As soon as you invest in it, the next month you get a check. Those returns are going to range anywhere from 7 to 9. Core plus might be a little bit of a slightly older product, maybe built 10, 15 years ago, maybe not as good of a location, but still a great location. Those returns should be 9 to 13%. And then you have value add deals, which is the space that most people play in today because that's where most of the opportunity is. And we believe it's the best risk adjusted returns. That right there is going to be anywhere from 13 to 17% on an IRR level. Now, I want to also say IRR is probably the most important metric that you as an investor should know about when investing in real estate syndications. A lot of people advertise AAR, average annual returns. And just to give you an example, sometimes AAR could be 20% or 22%, but the actual IRR is only 14%. Because the IRR, it stands for internal rate of return, factors in the time value of money. It factors in how quickly you're recovering cash flow on the deal, not just your compounded annualized return. And the reason why that's so important is because a deal where you're recovering your money, for example, equally from year 1, 2, 3, 4, and 5, versus a deal where you're recovering all of your money just on year 5, is 2 different risk profiles, right? The faster you recover money that you've put out there, the less risky the deal. So IRR is a very important number, but for point of reference, when we say 15, 16% IRR, that could equate to 21, 22% annualized returns. And we have some videos on our YouTube channel that really dive into the difference between IRR, annualized returns, and cash on cash, so feel free to check that out. And then we have an opportunistic category, that's 17 IRR plus type of territory. And opportunistic is where you're repositioning the whole tenant base. It's a very risky deal, usually poor areas, potentially up and coming areas that aren't there yet. So obviously the more risk, the more reward. But what we're gonna talk about today is kind of the value add space, because that's where most people are investing today because of the risk-adjusted returns. So let's talk about acquisition fees. So the typical range right now for acquisition fees is anywhere from 1 to 2.5%. Now, a key thing that you want to ask as a passive investor is this acquisition fee, is it based on the purchase price, or is it based on the total capitalization of the deal? And let me tell you the difference. So you could have a deal that's, let's say, $20 million, but the total capitalization on it might be $25 million, because maybe you need to invest $5 million of CapEx into it. So knowing the difference between that has a big difference, because now the fee, instead of being $200,000 at 1%, it's $250,000. And this is one of the things that I feel should be disclosed right away to investors. Usually it should always be kind of on purchase price. The only reason you would kind of do it on total capitalization, in my opinion, is because you want to make your fee seem lower than it is. But really, when it comes down to dollars and cents, the number is the same. So if I'm acting as a passive investor, I'm investing in somebody's deal, and I ask them what their acquisition fee is, and they tell me, let's say it's 1%, and they don't follow up saying based on total capitalization, that to me is kind of, I don't want to ask that question. I want you to tell me that. There's nothing wrong with it being based on total capitalization, but the question is, are you telling me up front? Now, big thing today is that you want to look out for is this. Is the fee over 2 to 2.5%? Whenever you see that the acquisition fee today over that range, I'm not saying it's a red flag, but it's something that you should start, you got to start looking at what the back end is, okay? You don't want to be seeing upfront fees of more than 2.5. I would say probably where the market is today is anything over 3% would be a kind of a red flag to me. Average, I would say, is 2%, sometimes 2.5%. And there's justification for that. So why would some deals be 1.5% and maybe another deal would be 2.5%? Well, the question is, how did you go and find the deal as the sponsor? There's a couple of different ways you could have done it. If you just went through the regular bidding process, and to give you a little context, the regular bidding process is essentially the commercial real estate brokers in this business. They know who the top buyers are in a particular market. So there's only maybe a handful of people, that actually get a chance to see that deal. When I say a handful, it's really probably about 20, maybe 15 that it's sent out to. Now, everybody gets a chance to bid on it. You go to best and final for offers, and really it's the best price wins, right? So one sponsor might have saw an opportunity that another one didn't, but those are kind of cookie cutter transactions. They're nothing that special where somebody could command, let's say, a 4% acquisition fee. On the other hand, if you went and you have a banking relationship where there was a distressed asset and the lender called you because you've done business with them in the past and they said, hey, do you want to buy this property from us? And there was no other bidders on it. If you got that exclusive type of listing sent your way, or maybe you've done business with the seller before and they called you and never marketed the deal, and you kind of have that first exclusive access to it. Some of those situations could warrant a slightly higher acquisition fee, but nevertheless, it shouldn't be over 3%. Now, if you see anything over 3%, the first thing that I'd be looking at, and the first question that I would ask is, what is your profit share? So usually profit shares in the business are kind of, the splits are 80-20, 70-30. That's kind of pretty common. So if I see somebody doing, let's say, for example, a 90-10 profit share or an 80-20, that's on the lower end. So that's where I would start spotting the imbalance, right? You're charging me a very high acquisition fee, but your profit sharing, the money that you're supposed to make on the back end, is kind of on the lower side. Why is that? Why not charge me a little bit less on the acquisition fee, a little less upfront? Let's say instead of 3%, let's say 2%. But instead of charging 80-20 on the back end, right, charge a little more, right? Do 70-30 split. The mathematics could come out just about the same, but now the question is, when are you collecting the money? Before performance or after performance? So that's acquisition fees. And the next thing I want to go into is loan guarantee fees. So what is a loan guarantee fee? Whenever you go and acquire a commercial real estate property, one of the criterias for the most part with lenders is that you need to have at least 100% of the net worth of the loan amount. So let's say you're buying a deal for $30 million and the loan amount is $20 million. Somebody in the sponsorship group or the combination of people in the group need to have a net worth equal to that $20 million. Okay, so because you have to kind of show your assets, you got to go through all that paperwork. Sponsors will charge a loan guarantee fee as well. And that's usually from 0.5% all the way up to 1.5%. Now, 0.5% is pretty standard. 1% you should only be seeing if there's recourse involved. So there's a difference. There's loans that are non-recourse. Non-recourse loans means, if something goes bad with the business plan, if you can't pay the mortgage and the bank has to take it back, the principal is not personally liable for that balance. Recourse is obviously, it's the opposite. If something goes bad and you can't pay that loan, the principal, the sponsorship group, is on the hook personally for that $20 million. So the risk level is different, okay? And in one, you don't have personal liability, and the loan guarantee fee should be less. In the other one, you do have personal liability, and if you're taking on that risk, you should get compensated for it. And that's where the fee could be about 1%, maybe even 1.5%. But here's an important note. When you look at loan guarantee fees and acquisition fees, I would look at them as almost one and the same, because they're being charged up front, right? So for example, if somebody is charging you a 2% acquisition fee and no loan guarantee fee, and somebody else is charging you a 1% acquisition fee and a 1% loan guarantee fee, dollar-wise and structure-wise is the same thing. It's still 2% being paid before performance. So the rule of thumb that you want to follow when you're analyzing opportunities is that 3% number that I said, that should include what they're charging for an acquisition fee and also the loan guarantee fee, right? So just because you see if you see an acquisition fee at, let's say, 2.5%, and then you see a loan guarantee fee of 1.5%, that's a very heavy fee load. You're talking about 4% in fees. So keep on the lookout for that. And the questions you need to ask, right? When you see that fee, you want to ask, is this a recourse loan or is this a non-recourse loan? As a mental note, remember, recourse loans, 1%, that's reasonable. If it's non-recourse, anything 0.5%, I would question. If you don't have recourse on the deal, sure, you have to show that you have the assets, but why are it's just not industry norm. This is not what people are charging. At least sponsors that really care about their reputation and are looking to do repeat business aren't going to charge you a 1% loan guarantee fee on a non-recourse loan. So I would say those are the big things you want to look at on acquisition fee and loan guarantee fees. And now let's go into asset management fees. Asset management fees, what is it for? So asset management is the function of ensuring that the business plan is actually executed. Now, it's not property management. Property management is usually outsourced to third parties. Some companies, they have their internal property management company, but somebody needs to look over the property management company. They need to make sure that tenants are being evicted on time that are not paying, that renewals are happening at the rate that they should be, that CapEx projects are being executed and improvements to the building, rent increases are going as planned. So there's a lot of management, a lot of spreadsheets, a lot of analytics, and also a lot of execution, right? It's not just looking at spreadsheets and just sitting around. You got to look at the data, and then you got to look at what did you initially forecast on the property, and if it's not lining up, right? If you said your payroll is going to be X amount, but it's Y amount, you have to go figure that out. Right, so that's kind of just a high level of what asset management is for. And the range for asset management fees is anywhere from 1% to 2%, okay? Now, why the range? And how should you look at it? So when a business plan doesn't have a lot of moving parts to it, when it's pretty simple, and I'll give you an example of a simple business plan, right? If you're coming into a property that's already 95% occupied, it's already cash flowing. You're mainly betting on, let's say, market appreciation, and you're cutting some expenses down. But it's not like a heavy lift. You're not renovating, half of the units and trying to get a rent premium on it. That's kind of, it's a simple execution. So when you see something like that, 1% would be the appropriate number. Now, then there's deals that are heavier on the execution side, right? So imagine you're coming into a deal and it's 80% occupied because the previous owner wasn't running it well. And you have a whole bunch of people not paying. So you need to come in, you're gonna need to evict a lot of people. You're probably gonna drop down to 70% occupancy. And then you have to boost marketing in order to get it to 90%. And you have to renovate half of the units to try to get a rent bump. That's a heavier execution. And an asset management fee on something like that of 2%, it correlates with the amount of work that you actually need to do. So whenever you see, as a passive investor, you shouldn't really be seeing too much over 2%. If you see something over 2%, first question I'm asking, what is so complex about this business plan that you're justifying let's say it's 2.5%, that you're justifying a 2.5% asset management fee? Or if you see 2%, but you see a very simple kind of cookie cutter deal, I would ask that question as well. Also, you want to make sure, is the fee based on the gross income or the equity raised? Those are very two different calculations, and you shouldn't be seeing equity raised on deals. It should be based on gross income. Sometimes equity raised could be appropriate, and I'm going to go into that in just a second. One is fee-based, right? So fee-based, if the property earns, let's say, $2.5 million in gross income, and the fee is 2%, that means the sponsor is going to earn $50,000 a year for managing that deal. Now, fee-based is great because in order for them to make more money, they have to increase the revenue of the property. Now, if the revenue of the property increases, that means it's going good for everybody, not just the sponsor, but also the passive investor. Now, if the fee is based on equity raised, right? I'll give you another example. Now, if you have $10 million is raised and they're charging 2%, instead of $50,000, that's $200,000 a year. As you can see, there's a really big difference between those two modeling structures. So you always want to ask, is this fee based on gross income or is this fee based on equity raised? And over here we have a little bit of a chart that shows a difference. As you can see, the difference between a similar deal would be about $150,000 in fees. What I'd be personally looking for is, if I'm talking to somebody and they're presenting a deal to me, if you're going to tell me the asset management is 2% and it's equity based, you should say it's 2% and equity based. I don't want to ask you that question. That should be disclosed right away to me, because if it's structured that way, it's not really a 2% fee. You could look at it as a 6% fee. So keep that in mind. Now, when is gross revenue? Gross revenue is appropriate probably for most deals that you see, right? Most deals that are in the market today that have some type of cash flow, even if they have some execution risk or a business plan, it should be based on gross income of the property. Now, sometimes you have these very heavy lifts. For example, let's say it's a multifamily development where it's going to take 24 months before there's any revenue. Let's say there's a construction period before, and let's say there's a lease up, right? So in that situation, the sponsor has to do a whole lot of work those 2 years, but there's no actual revenue for them to collect any money from. So when you see a deal that clearly, the sponsor isn't going to be making money for the first year or 2 years, possibly in that situation, an equity-based fee could be appropriate. But for the most part, if you're dealing with just value-add multifamily deals, even if they're 70, 80% occupied, there's still gross income coming in, right? I'm talking about if a business plan has no income coming in for the first year. It's pretty common in development, when you're building new product, right? You got to build it before you could rent it, right? In that situation, this is going to be more appropriate. So some of the questions as a passive investor that you should ask, right? Is this fee based on equity or gross revenue? You want to then ask, is it appropriate, right? Based on the type of deal it is it appropriate for that? And I think that's going to pretty much tell you everything that you need to know about kind of sponsor intentions and whether or not they're in line. So those are the two calculations on asset management. The big thing, asset management fees, the red flags are if the asset management fees don't equal the level of oversight that needs to happen, which I've covered in detail, that should be a red flag, right? If you see a 3% asset management fee on kind of a simple execution deal, there should be some questions around that. Calculating based on equity raised when it shouldn't be. We just spoke about that. So I would say that's another red flag around asset management fee. And the last thing is looking at things holistically. I wouldn't say asset management is necessarily the same upfront fee as, let's say, an acquisition fee, but it's still a fee that is being earned before performance has been delivered for the investors, right? So I would still blend it in to the overall picture. So now I'm going to look at how are they structuring the acquisition fee, the loan guarantee fee, and the asset management fee. And I would look at it holistically, right? If I'm seeing that the acquisition fee is over 3%, if I see there's also a loan guarantee fee, if I see the asset management fee is 3%, all of those things combined show that the sponsor is structuring a very heavy fee load before they've actually delivered a result. So going back to my original point, again, fees are a necessity in order to run the business. Otherwise, you can't keep the lights on just waiting for a profit 5 years down the line. But there's a balance to that, and you have to be in line with the market. So hopefully you guys can take some of this information, and when you're looking at some of the opportunities that are being presented to you, you're going to be able to spot some of these inconsistencies and make better decisions on who you invest in and what type of properties you deploy capital into. So the next fee that I want to talk about is disposition and refinance fees. So these are pretty simple. This is a fee for refinancing or selling the property. They usually range anywhere from 0.5% to 1%. And the fee is really for the sponsor coordinating everything they need to coordinate for the refinance, right? Submitting all the paperwork, selling the property. Now, those are two different events, so you want to ask, is there a refinance fee and a disposition fee? Now, not every business plan has a refinance kind of modeled into that business plan. Sometimes it's just buy the property. Actually, most of the times I would say it's buy the property, execute the plan, sell the property, make a profit. But sometimes along the way, they might refinance. So if there's a refinance, you want to ask, is there a refinance fee and a disposition fee, and how's that structured? Some of the questions you want to ask around refinancing is, if you refinance, is that money first going to be used to pay back our principal balance as investors and our preferred returns? Preferred returns, I'm going to go into as we go through the webinar. It's a very, very important metric and a very important thing that you must know about. I would say it's a huge either alignment or disalignment of interest. But for now, keep that as a question to ask around disposition fees. I would also ask what needs to happen, for the fee to trigger. Like, is it you just start the refinance, or is it once it's complete? So you want to make sure it's upon execution of everything. And lastly, you want to ask is everything already baked into the pro forma? And this is going to be an important concept to understand, right? There's deal level return metrics and there's net to investors. The difference is deal level is what is the deal making overall before the sponsor makes any money. And then there's what is the return to investors, right? Usually the return to investors is going to be anywhere from 200 to 300 basis points lower than the deal level returns. And the reason is obvious, right? The sponsor needs to be compensated for all the work that they've done, to acquire, manage, and sell the property. So when you're talking about all these fees, a great question to ask, the metrics that you represented, if they told you that the cash on cash is going to be 8%, if they said in 5 years it's going to be a 2x multiple, you just want to, if you walk away with anything, I would say it's this question. Ask what you represented, is that net to investors? Is that after all fees are accounted for? Right? Because if somebody is advertising a 2x return, but after fees, it's not actually a 2x return, that should probably tell you all that you need to know. So with that, let's go to junk fees. So junk fees, we've seen people doing some crazy stuff out there. We've seen sponsors paying for their travel. We've seen sponsors billing for their time. billing the property for the time they spend working on it, paying for dinners and things of that nature. This is very rare. Most people in the industry kind of know the only thing you got in this business is your reputation. If you're just looking to do a couple of deals, I mean, sure, there's some guys like that, but for the most part, you're not going to see this a lot, but ask anyway. There's nothing wrong with asking and just making sure, are there, besides the asset management fees and the fees we spoke about, are there any other fees? Are you charging for being on the property, travel, things of that nature, right? Because all of those things should be included in the asset management fee, right? You shouldn't be being charged an asset management fee and then the people working the deal also charging you by the hour for the time they spent on it. So again, it's very rare, but nevertheless, it could come up. So just something to keep in mind. Now, we've spoken about kind of these upfront fees that are a necessity as long as they're in balance. Now let's talk about the GP promote. So the GP promote is essentially the performance-based compensation. This is what aligns interest, right? It aligns the interest of the GP and the LP, because this is saying, when we make money on this deal and we deliver profits to investors, that's where we're going to get the lion's share. And the key word is that's where you want the lion's share of the compensation to be for the GP. Now, how is that usually split up? Now, that's usually common in the industry is 80-20. So whatever profits are made, the GP will get 20% and 70-30. I will say that 80-20 is on the low side. You don't see a lot of 80-20s out there. You do see them, but as soon as you see an 80-20 split, the next question you should be asking yourself is, how are they structuring their upfront fees? Right? Because I would rather, if I'm a passive investor, I would rather do a deal that has a 70-30 split instead of an 80-20, but you're charging me less fees on the front, because now I know our interests are more aligned together. So today we're going to discuss that. I'm going to dive into a couple of details. We're also going to talk about preferred returns. We're going to talk about hurdles. Hurdles are benchmarks that a GP must hit in order to increase their compensation. Just as a side note, hurdles for a passive investor are great. You want to see a sponsor setting hurdles. That means they are incentivizing themselves to outperform your numbers that they're presenting to you. And we're also going to talk about catch-up promotes. Catch-up promotes are a big, big thing. If I'll put it to you this way. If you have a deal that is 80-20 without a catch-up promote, or I'm sorry, an 80-20 deal with a catch-up promote could be less attractive than a deal that's 70-30, but no catch-up, where the profits are actually more in the favor of the LP. So as we go through some of these topics, I'm going to dive in a little bit more. But the first is I want to talk about preferred returns. Preferred returns really equal alignment of interest. So first, a preferred return is essentially a percentage that before the general partner can share the profits of a deal, the limited partner must recover not only the balance that they've put in, but also they have to recover a certain percentage on that balance. Usually, right now, preferred returns are anywhere from, I would say, 7% to 10%. If you see anything over 10%, there could be some clauses in there where it's probably a little too good to be true. And I'm going to educate you what some of those things are. So what does that mean? What does an 8% pref means? I'm going to give you an example. Let's say you as an investor, you put in $100,000 into the deal and it's a 5-year hold. And the pref on that is 8%. That means 8% every year should deliver you a minimum return of $8,000. So if it's a 5-year hold, 8,000 times 5 is going to be 40,000. So what a pref should mean is that before the GP collects their 80-20 split, or before the GP collects their 70-30 split, you must recover not only the $100,000 that you initially put in, but also that $40,000 in interest. Now, some of that money you might have gotten from distributions along the way, but when it's time to sell the property, it's time to exit where most of the profits come from. Just using that 100 grand as an example, you got to get back your principal balance, the preferred return, and only then should the GP be making their share. Now, sometimes GPs have different clauses in there where they'll start collecting promotes before the actual balance is fully repaid. So they might deliver the pref, but let's say your 100,000 didn't come back, and now that's called a GP catch-up provision. And that really increases the profits to the GPs and decreases the profits to the investors. So you always want to ask, if somebody says this is an 80-20 with an 8% pref, you want to ask, is there a GP catch-up provision? And if there is, first question I'm going to be asking is, why didn't you tell me? Right? I don't want to ask you that question, right? I want all that should be disclosed to me, right? Because an 80-20 deal, I would rather, like I said before, I would rather do a 70-30 deal without a catch-up provision than an 80-20 deal with a catch-up provision in many situations. Because the numbers kind of come out the same with less protection. So that's what a pref means. It's really to make sure the investors get paid first. And I would say besides a sponsor having skin in the game, I would say this is the second biggest factor that aligns interest is what kind of preferred return are you structuring and how are you structuring it? Because not all preferred returns are created equally, just like I gave you an example just now. Now let's dive into essentially a little bit more on catch-up provisions. So as I mentioned, with a catch-up provision, without a catch-up provision is simple, right? GP only earns a promote once you get your pref and your capital. Now with a catch-up provision, that means the GP can start earning their promotes sooner. So maybe they just delivered you the 8% pref, but they haven't delivered your full capital back, your full, let's say, $100,000 investment. And now they're collecting their 80-20 split on future distributions. That's going to skew the numbers. That's going to make the deal less profitable for the passive investor and more profitable for the general partner. Now, there may not be anything wrong with that, right? Because maybe that's just the economics of the deal. But the question is more, are you disclosing that? And how are you marketing? Right? That's the big thing. How are you marketing? Right? Because why wouldn't you just market a 70-30 with no GP catch-up provision? Why are you marketing an 80-20 and then putting a catch-up provision? Is it in hopes that I don't ask that there's a catch-up provision? Again, me sitting in a passive investor's shoes, and I look at a lot of deals myself and look at opportunities to invest in other people's deals, this is how my mind works. When I see them structuring deals, I want to see how transparent are you? Because there's nothing wrong with these structures, but are you being upfront? Are you telling me this before I ask you? Or are you presenting me kind of this rosy picture and then you have some of these provisions kind of built in? Keynote, takeaway, every time you hear a split, every time you hear a pref, always ask, is there a catch-up provision? Because that is going to change your economics a lot. And if you want, you could also ask them, can you tell me a scenario of how different my profits would look like as a passive investor if there were no GP catch-up provisions? That could be pretty insightful to see as well. So conclusion on preferred returns, what do you want to look for? Again, today, what you want to look for is an 8% pref is very competitive. An 8% pref that is cumulative, that doesn't have a catch-up provision, because of where the cash flows are on a deal, that is competitive in today's market. If you see these ads on Instagram, Facebook, YouTube, right, people advertising 10, 12% pref, a lot of times they have these GP catch-up provisions in them, or they have very heavy fee loads in the front, and that tells you a lot, right? If you're giving me a very high pref, but you're charging very little, if you're giving me a high pref, but you're charging me a lot of fees, that's telling me that you don't really believe that much in making the money on the back end, and you're trying to make the money more on the front end. So this is what you want to confirm. Couple of points, right? You want to say, do I receive all cash flow distributions until I am made whole, and I've collected my minimum pref. So you want to make sure the cash flows of the project go only to you until you collect your initial balance and the preferred return. You also want to ask if there's a refinance event that happens during the business plan. Are you going to first pay down the accrued pref and whatever I've put in before distributing any cash to yourself based on the profit share? And does your group earn any promote before the preferred return is paid? The answer should be no. And here's another big question. You want to ask, does the pref start accruing from day one? Like the day that I send money in for this project, sometimes, if the deal closes, but for whatever, somebody put in their contract that pref is only going to accrue 6 months down the line, that's not a real pref. I mean, you could say it is, but that would be a big red flag. That should be the takeaway on something like that. And I'll give you an example. This is a deal that I've seen recently. 5% acquisition fees. It's a $20 million deal, right? 5% acquisition fee. So the sponsor is making $1 million just buying the asset. And guess what the pref was? The pref was 16. That, the deals today, overall, the target returns are, great returns right now are going to be 17, 18%. If you're setting a pref at 16, you're saying pretty much all the back end profits, I want all those profits to go to the investors. Essentially on that deal, the GP has zero incentive for the deal to perform. Zero, right? So it's very hard to achieve a pref over 16%. And when I saw the 16% pref, I said to myself, wow, that's amazing. And then I looked at the fee structure and I saw 5% acquisition fees. I saw 1% loan guarantee fee. So they were going to be charging like $1.2 million up front. And then I saw a 4% asset management fee. So essentially on that deal, they were going to make about $1.8 million without having to deliver any result. So that's just an example of some of the stuff. Now, I probably had to look at 10 different opportunities to see that, but I just want to make sure that people on this call don't invest in that 10%, because that 10% are the deals that you want to avoid like the plague. The last topic I want to talk about is LP hurdles. So LP hurdles are essentially return thresholds that a sponsor must hit in order to get higher, in order to receive compensation or to receive a higher compensation. So the preferred return you should look at as the first hurdle, right? That is the first performance hurdle for the GP, right? So if it's an 8% pref, what is that saying? I have to deliver these type of returns before I could make any money. Now, sponsors will also bake in sometimes a secondary hurdle, which is a good thing. So a secondary hurdle could look like this. I am forecasting 16% returns on this deal, but anything I achieve if I achieve anything over 16%, instead of having a 70-30 split, I would like to have a 50-50 split. Now that's a very reasonable request, right? Because the sponsor is saying, look, I'm only going to make this money if I completely hit this thing out of the park. If I really outperform, I should make a little more money. And that's 100% logical. If I'm structuring a deal with investors, I'm definitely going to have a hurdle where if I completely hit it out of the park, to have a little bit more of an incentive. But I'm also going to be structuring it so we don't have a lot of upfront fees for investors as well, right? So hurdles are a good thing because it shows that the sponsor is really trying to hit these thresholds. Now, here's where a hurdle might not make sense. If you have somebody that is projecting, let's say, a 15% return, but then they set a 50-50 hurdle, anything above 12%, that should be a head scratcher. Because why would you get more compensation for going over 12%? Your marketing is showing that you're targeting a 15% return at a 70-30 split. You shouldn't have a hurdle at 12. you should have maybe a hurdle at 15, but not at 12. So that's something that you want to keep an eye out for, and just make sure those hurdles are structured fairly. So that's a little bit about hurdles. And understanding alignment, right, is a 70-30 split with no hurdles, or an 80-20 split with a 50-50 hurdle above 15%, right? Which deal do you feel shows more sponsor confidence, right? Me personally, a deal that is structured 80-20 with a 50-50 kicker, if you really outperform, shows more confidence than a deal that is just 70-30 across the board. So not saying that 70-30 across the board is bad or there's anything wrong with that. A lot of people actually do prefer that, and because it's a little simpler, maybe less calculations, less math you need to do on distributions and things of that nature. Some investors also prefer that, right? It's kind of simple. They don't need to track as much. But in terms of incentivizing performance, the 80-20 deal with a 50-50 kicker is going to align interest a little more than that same deal just at 70-30. To conclude, right, the waterfall, how should it go? You invested your money. The first thing, all distributions that come from the property should go back towards paying back your preferred returns and the capital that you initially put in. The next could be a GP catch-up if there is one, or then the GP makes money. That's how a good waterfall should go that is investor friendly and aligns interests. And here's just kind of a quick little checklist, 5 questions you could always ask, right? Is capital and pref return before promote? Answer should be yes. Is preferred return cumulative and compounding? Answer should be yes. Are early distributions funded from operations? Should be yes. Does the GP have meaningful skin in the game? Again, answer should be yes. And is the sponsor setting performance hurdles? Also a great thing to have. So with that, I'm going to leave off with this prompt that you could put into ChatGPT. And we're going to send this deck out to everybody that is on the webinar. So the prompt reads like this. You're a world-class real estate syndication attorney representing the interests of passive investors. Analyze the following private placement memorandum and operating agreement to assess whether the sponsor fee structure and compensation terms are fully disclosed and properly aligned with LP interests and are transparent. Specifically, so if you take this prompt and you just, the steps would go as follows. Get the operating agreement, get the the PPM, private placement memorandum, upload them into ChatGPT, and then just copy and paste this prompt, and it will give you all the bullet points that you need to know as a passive investor. It'll tell you there's misalignment here, there's alignment here. You could even ask, how does this compare to industry standards? That's probably not going to be that accurate. I don't think ChatGPT is fully up to date with day-to-day market conditions like I would be, but nevertheless, this is going to show you a lot of misalignment and could save you a lot of time. And that's the process that I would go. I would first ask all these questions over a call, but then trust but verify, right? Get the docs, put them in, run this prompt, and see what it says, right? Because when you're picking partners to work with in this business, the more important thing is it's not the deal, it's the partner. Because think about it this way. The partner is the person that is going to operate and execute that business plan, right? So you really want to see, how does this person do business? What is their philosophy? What is their outlook? How transparent they are? Because if I'm doing business with a sponsor and I have to go through all this due diligence to find out what you're really about, I want to do multiple deals with you. I don't want to do 1 deal, 2 deals. I want to do 3, 4, 5 deals with you, right? Because if I have to do this on every single sponsor consistently, that's a lot of time. Right, so the goal should be is find a couple of people that you're really comfortable working with, but before you've actually transacted and worked with them, and you haven't seen them deliver a result, these are the steps that you could go through in order to ensure that you're partnering with the right people. So that really kind of concludes us for today. We're going to jump into Q&A, but if you guys have any questions, anything that comes up where it's, so we got some stuff that came in on the screen here. Yeah, well, we've seen a couple of them. Again, they're rare. They don't happen a lot where the acquisition fee is based on total capitalization. It really depends on the type of deals that you're investing in. So sometimes it just kind of really varies. So it doesn't really happen that often, but it's definitely out there. So we just want to give you guys all the information so you can plan for it. What about a 50-50 split and no GP level fees? Yeah, I mean, it's just never seen that in the market. I think the reason that doesn't really happen is, like I said before, a business plan, in order to execute a business plan, it's going to take, on the low end, 3 years. Usually they're 5 years, usually they're 7 years. So if you're going to partner with a general partner and essentially tell them you're only going to make money when you exit the deal, it's going to be hard for them to, there's quite a bit of payroll, right? We have underwriters, we have acquisitions people, we have marketing expenses. So it's hard to keep the business going. So that's why fees exist. You need some of them, but you just need to know the difference between what's fair and what's excessive. Yeah, sure, it shows GP commitment, right? No fees, but it just doesn't exist, right? It's just really asking somebody to go and work a couple of years without getting anything. It's just not there. The sponsor's earning 2% on the PP or 400,000 in the example. Should they put all of it into the deal or a large portion? Yeah, that's a great question to ask, right? When somebody is investing a percentage of their capital, when somebody's telling you, I'm investing 5% of the deal, you want to ask, is any of that coming from your fees? Are you rolling in your 2% acquisition fee? The way I would look at something like that is if you're saying 5%, but you're rolling in 2%, that means what's actually coming out of your pocket is only 3%. That will vary, but that's the way I would look at it. I just want to make sure when they're saying I have skin in the game, that it's real skin in the game, that it's money leaving their bank account and not just fees that they're charging and then rolling into the deal. Can you share good deals with great tax write-offs for 2025 with passive income in? Yeah, actually, absolutely. We have actually some opportunities right now. We have a great cash flowing deal in Houston we're about to go in on. We're actually funding the whole thing from our internal balance sheet. It's a $23 million deal, but we're gonna, after we fund it, we might bring in some outside investors. So if you want to know more about the deal, feel free to shoot us an email, invest@investav.com. More than happy to jump on a call and go over the details on that. Thank you everybody for joining. Appreciate the time.